I find that in India there's almost no discussion. So okay, so that's that about HS Tech. Now let's talk about your other extremely successful ETF product, which is the FANG Plus, and that incidentally completes 5 years very soon. And the return there is, of course, spectacular. It's in the mid 20s, if I remember correctly. CAGR.
Yeah.
Did you have any inkling that the return would be so strong? Because 21 was a big spike for all
Yeah.
tech stocks. And I remember thinking, my God, I don't think this will last.
So actually, since now that it is happening, people will say that I'm just looking at the past data and saying it. But since the very start, I had very strong inkling of FANG and AI ecosystem doing well, and that is why we launched FANG in 2021, and we launched Artificial Intelligence and Technology Fund of Fund in 2022, way before all this conversation started. The reason was it was quite apparent that when you look at the uh, the tech leaders in US, you saw them continuously innovating,
Yeah.
right? Burning cash, burning money, uh, just to innovate, and you saw them becoming leaders in upcoming disruptive technologies itself. You don't have to look outside FANG to find a leader in cloud,
Yeah.
right? One of the leaders in now AI is part of FANG. You have to,
Yeah.
when you look at FANG plus a broader 10 stock, semiconductor, etc. is there. So we were very bullish on this entire disruptive tech play, and that's why we just not only launched FANG, which is focused on US, but we also launched AIQ, which is Artificial Intelligence and Technology Fund of Fund, which is, let's say, 85 stocks, global AI, tech, semiconductor stocks, and that is also doing very well. So when we launched it, the valuations were higher. I remember we were justifying at that point in time how Apple can be $1 trillion company. That was the question, and we had to like a properly do analysis that how do I justify? It was $1 trillion at that point in time.
Was
5 years
huge,
back
yeah.
was huge, and now we just saw SpaceX raising $75 billion
Yeah.
and coming at a valuation of 1.7 trillion. A
Yeah.
company which has not made profit yet,
Correct.
right? And now you are seeing so many Nvidia, etc., touching $4 trillion, etc. So that's
So the interesting
phenomenal.
thing is US tech was not cheap in 21 when you launched it, but
Yes,
the
yes,
the
but
bet still paid off.
but the thing is that even if you look right now, if you look at the earnings which is projected for next 1 year also for FANG, it is north of 50%.
Wow.
Yeah.
50.
50. If you look at semiconductor ETF, which I was talking about, it has given 100% EPS growth in last 12 months, and next 12-month projection is also 100 plus percent.
My God.
Yeah. If you look at earning projection of Nasdaq 100
Yeah.
for next 1 year, I think it is again around 40% plus or so.
Yeah.
So my point is that higher valuations are okay if it is being justified by earnings.
So Siddharth, let me give you the bear case on AI.
Yeah.
People are saying that AI companies are investing huge amounts of money, and that is essentially the risk, and those investments are flowing down the value chain. So
Right.
that's inflating the valuations of everyone
Correct.
down there, the chip makers, etc. But if those investments do not pay off, because ultimately they need to pay off when all of us as consumers start paying the AI companies
Absolutely.
lots of money, then this whole thing bursts.
Absolutely.
What is your take on that?
So I think burst is a very strong word. So this is not, let's say, equivalent to what happened in .com. Why? If you look at FANG plus constants, people will be aware about that. If you just look at annual profit, net income, aggregate net income is $600 billion.
Okay.
If you look at AIQ, which is Artificial Intelligence Technology Fund, which we have,
Yeah.
if you sum all the profits, it is north of $800 billion.
Okay.
Okay. And the projection is that this year the spending will be roughly around $700 billion in AI. Through 2030, the aggregate spending will be roughly around $5.5 trillion. That's the rough estimate.
Okay.
So $5.5 trillion till 2030, let's say if that happens, and current profit itself is, let's say, $600 billion if you're looking at FANG or $800 billion. So first of all, these companies are well capitalized. These are just profits. If you look at their cash balance, it's equally great. So my point is that
But if I could make you pause there for a second, the figures you gave essentially show that they are spending their entire current profit into investments.
correct. So my for the first point is that they have enough income stream to fund that. They are not leveraging in a manner. Yeah, some of the, like for example, Google recently
Yeah.
has raised some money, but it's not overboard, right?
Okay. They can
Their
repay.
hunger
Yeah.
can be satisfied by the
Okay.
income, etc. So I was reading one report which just talked about that if the AI related revenue
Yeah.
is in the region of 1.5 trillion to 2.5 trillion,
Yeah.
then this would all make sense.
I see.
Okay. So the risk is not, I think, spending per se, because it's not as if that they are borrowing so much and there's a huge issue of debt. The risk is, what if monetization does not happen
Exactly.
to the extent we believe it should? The theory is that if it is, let's say, just 1 trillion or below 1 trillion in terms of revenue, that's a risk. If it is between 1.5 trillion to 2.5 trillion, which is what people are assuming as a base case, is going to be is going to be okay. So I think that debate ultimately, Neil,
Cannot
will,
be settled.
yes, it will happen. We'll only get to know, let's say, after 2 years itself, because we have to see monetization happening, and that too at an enterprise level.
Right.
You and me purchasing Claude
It's not going
is,
to.
is not going to obviously satisfy
Yeah.
this, because what enterprise needs to know is that the money which I'm spending on AI is fantastic, right?
Yeah.
We both
Yeah.
know that.
Yeah.
But from a cost point of view, is it getting me that extra margin,
Yeah.
right? Is it creating extra margin for me? That debate I think will take 2-3 years. But if I simply look at current earnings growth,
Sure.
and I talked about the semiconductor trailing was 100%,
Yeah.
upcoming was 100% plus, Nasdaq is 40% plus, FANG is 50% plus. In fact, if
Sure.
I just simply do, it's around 70% right now, 70-75%. So right now it seems that it is all okay. Earnings are justifying the euphoria, but ultimately it has to translate into monetization.
Sure.
And I think it's too soon to speak
To call
about
that.
it right
Okay.
now. Yeah.
I accept that. A lot of people who invest in AI are hedging themselves by not investing in the likes of Fang Plus.
Yeah.
Because these guys are making the fundamental models and they're at one stage, it's like a 5 layer cake. So people are going down the layers and either doing the chip makers or doing the data centers or doing the electricity,
Correct.
the power companies.
Yes.
Would you agree that that's the way to play it?
Yeah, I think right now that is being justified, right? Because one of the biggest, the one who is taking the most advantage is the semiconductor companies,
Yeah.
because all these, let's say Google, etc., are burning so much money in setting up the underlying infrastructure. And that money is
Yeah.
going to
Yeah.
semiconductors, etc. So globally, we manage $270 billion in ETFs,
Yeah.
and you won't believe that our semiconductor ETF in Korea crossed $10 billion.
I've always wondered, Siddharth, this is one miss. You're a Korean company. You never gave Indians an in Korea ETF to invest in Korea.
My product after AIQ was going to be on Taiwan and Korea. So at that point in time, we were ideating that let's launch a product
Yeah.
which just give you exposure to Taiwan and Korea. That's it, nothing else. And post that, this restriction came out, we would have launched fantastic products. So if I'm just looking at what is working well globally, because we do a lot of thematic products globally, our semiconductor product is doing fantastically well, obviously.
Yeah.
Uh, we are very bullish on AI data infrastructure. We already have a product in US,
Yeah.
and defense tech is also doing well globally also. So we see all in the entire ecosystem doing really well. The expectation is that yes, semiconductors and people who are actually building the infrastructure right now are actually seeing money coming in, but eventually hyperscalers, you will see also eventual, when if monetization happen, you will see Google, etc., doing also really well, because ultimately all this spending will get justified.
Yes. Now let me shift gears to another area of ETF and passive investing that has grabbed the headlines of late, which is all of the gold ETF closures. When I say closures, I mean stoppages of fresh flows directly by the AMC fresh creation units uh, by large investors above 25 crores. And also fund of funds saying that above 10 lakhs you can't invest. That's capped. is there a shortage in the physical gold market because ETFs have to back up every single unit with
Yeah.
physical gold?
Yeah. So there's no shortage in gold, and right now there's no shortage in silver also, because government actually imposed import restrictions on silver. So where we were actually concerned about silver liquidity, but actually there's no liquidity crunch right now in silver also. And gold, I think there's none at all. There's no worry in gold. What is happening there is obviously because Prime Minister spoke about buying less gold, etc. So there has been some moves in order to probably reduce investments in gold products, so that
That could have prompted it.
yes, exactly, so that import of gold is reduced, because ultimately we import our gold,
Yeah.
right? And
Yeah.
those are LBMS certified gold bars.
Yeah.
So I think that's the reason why the supply is not a concern.
So the investor concern here is that if no fresh units of the ETF are created, then
Yeah.
the existing units will trade at a premium, which is
Yeah.
what has happened with your foreign feeder units, your ETFs
Yeah.
feeding the FANG Plus and HS Tech.
So the situation is completely different. In international ETFs, the market makers are not allowed to create fresh unit. I cannot create fresh units. So the whatever is happening is basically on supply and demand, because there's so much demand of FANG, people are able to sell up at 20%
Yeah.
premium, right? Uh, but in case of gold ETF, what is happening is that if you read the notices, there's no restriction on market maker. So market maker will continue to go to AMC to create fresh units, to offer those fresh units on exchange for new investors to acquire those units. Similarly, on the selling side, they will be able to simply go to the asset manager and sell those units. So there shouldn't be a problem of premium. The problem of premium, I'm just trying to
Sure.
envisage all these scenarios, can eventually happen as of now in silver if import restrictions continue and ultimately whatever is there in India gets absorbed.
Yeah.
We don't see that happening because the demand of silver ETFs have also gone down,
Yeah.
right? But if similar import restriction happens on gold, which hasn't happened till now,
Yeah.
then similar situation can happen there also. But current scenario, I don't see issue of premium happening in ETFs. ETFs will replicate what is happening in underlying domestic physical market. So, one thing which can happen is that
So
what
in
if
fact, let me touch upon that because there was a big SEBI circular which changed how gold is priced by ETFs from
Correct.
LBMA, the London Bullion Market, converted
Yeah.
to rupees,
Yeah.
to the domestic price of gold.
Hmm.
How is the domestic price of gold determined?
So actually, there is some bit of confusion on how you should assess gold ETF, right? Because some people try to compare the performance with MCX futures. That will not hold true,
Okay.
because futures has a different way of moving.
Yeah.
Some people try to compare with international prices. That will not happen, because then you have to obviously think of currency, etc. You have to compare it with domestic physical spot market,
Okay.
because we invest by purchasing these from our bullion traders who are what they are doing is they are looking at international prices, they are converting using forex, adding duties,
Yeah.
etc. And then they are
Adding 15% customs duty.
yes, and they are also doing premium and discount separately,
Okay.
which is basically what is the supply demand dynamics here.
Sure.
If internationally silver is trading higher, but India there's no demand, they may actually give it at a discount. If there's
Okay.
more demand, they can give it at a premium, which is not major, but there's some bit of premium discount.
But if I may go to the question, how is this price determined? Is there a poll of all bullion traders?
Yes, so we basically, so every day MCX gives out gold and silver spot prices,
I see.
and we use that for valuation.
I
So
see.
earlier also what we are doing, at least major AMCs were using LBM as a base price, and then we were allowed to build in domestic premium and discount.
Okay.
Ki what is the domestic premium discount in India?
I see.
And then we were actually reverse calculating domestic premium and discount to value our units equivalent to what MCX spot is.
I see.
So CBS said that nothing doing, don't do all that so much of mathematics, just simply use MCX spot.
Yeah.
So they have just reduced the maths, everything else remains same.
So this is interesting. The domestic price of gold can diverge significantly.
So what we have seen, and again, in last 2 years, all the correlations have gone for a toss. But
Yeah.
typically, if you look at a long-term average, uh, gold typically trades at a premium of around $2, $3 compared to international
Apart from
prices.
customs duty, that is separate.
Yes, that is separate. That is separate.
So if I add 15% customs duty,
Yeah.
now I don't know what $2 is as a percentage, but
So let's say
yeah.
let's take an example. This happened last year.
Okay.
So there was obviously a supply chain issue, and we couldn't import silver in India.
Mm.
So let's say silver in international markets, let's say we're trading at $70 hypothetically.
Per ounce.
But since we cannot import silver in India, there's a huge issue of supply and demand crisis, and that $70 actually started trading at a $77 in equivalent terms in India, and that's not saying that ETF is trading at premium. If you would have gone to a jewelry shop,
Same.
he would have given it you at $77 because there's no silver. So it's all about supply and demand. If a new iPhone is released in India and you don't find an iPhone Pro Max, let's say people are willing to pay 10-20,000 premium. That has also happened in gold and silver because ultimately it's all supply and demand. So there can be dislocation with international prices depending what is the demand or demand in
So
India
it
for
could go
gold.
as high as 10% in that example.
It can go higher also. It can actually go at a discount also.
Finally, on this gold ETF question, some people are now asking about EGRs because the facility there with electronic gold receipts is that you can take delivery of physical gold, which you can't do in an ETF.
Yeah.
My objection to that has been 3% GST. Unless you want that physical gold, if you just want to capture the price of gold, ETF is perfectly fine.
Absolutely.
Would you agree, or are there other issues also to consider?
See, first of all, ETFs are very transparent. And then there are 20, 30 AMCs who are offering
Yeah.
gold ETFs. So there's a lot of competition. In case of EGR, you have an exchange offering,
Yeah.
right? In case of ETF, you know the cost. In case of EGR, first there is a liquidity issue. Right now, almost 50% of liquidity in ETFs is gold and silver. There was a time, Q1, I guess, when daily trading value of silver ETFs was, I think, roughly around 5-6 thousand crores, right? So point is liquidity is the king because it reduces the impact cost.
Correct.
Because same thing happened, if you remember, Neil, with SGB also. You can buy and sell in on the exchange, but there was a lot of premium involved. So that eats into your return. So there is storage cost also, if I
There is.
know correctly. So all these things will eat into the returns. So always favor the product which is more liquid, more transparent, and you know what you're getting into. So if ETF is here right now, prefer ETF. If 5 year down the line EGR becomes equally liquid, I think probably we'll say that you can pick whatever you want basically.
Finally, large cap stocks in India are at a significant valuation discount to the SMIDs basically.
Yeah.
So are passive funds ETFs a good way to play this?
I think there's a very interesting calls which are going on, and that's the beauty of passive. You can be your own fund manager. So I tell you, within large cap, what is happening? Some people now want to invest in Nifty 50 because it is actually at a discount to its historical averages in terms of valuations. Some people are still apprehensive of larger private banks and ITs, etc. So they are investing in Nifty 50 equal weight. If you look at Nifty 50 equal weight, same set of stocks, equal weightage compared to Nifty 50, it has actually delivered much better returns relatively than Nifty 50. And then people are also looking at Nifty Next 50 also because that is where again returns have happened. So within large cap, you just have to look at top 20 returns. I think 1 year return is significantly bad compared to Nifty 50 equal weight. So top have not done well. So some people are now saying that for a long term, it's better to invest in Nifty 50 equal weight. Some are saying that mean reversion is a theme which people are talking about in the last 2-3 years. So mean reversion will happen and top 20 is a better play. My point is that depending on your investment objective and how you like to play the markets, there are plethora of options how you can now invest in a multiple different ways with a large cap also.
Okay. One final question on Nifty. Yeah, on large cap ETFs. There was a recent launch by another fund house of an active fund on simply the premise that you can have an ETF plus or a index plus category. Because when there is 6 monthly rebalancing of the indices, it's announced beforehand. So any active fund can legally front run that rebalance, and so your passive guys are paying the price.
Yeah.
Would you agree?
But that is the story since last 30 years. We are still seeing active funds underperforming. Now, not so much in large cap category, but in mid cap category significantly. So my point is that that's all noise. Pick out good product on the active side also, on the passive side also.
Okay.
I think a blend of, let's say, a 50-50 of active plus passive is beautiful. Don't get into the conversation of active better hai ki passive better hai.
Sure.
Because at times passive is fantastic
Yeah,
and at times active funds are great.
fair. So that, thank you so much. It's a pleasure having you.
Thank you so much, Sheen, for having me on the show.